Hello and welcome to Forex.Academy, the #1 website for Forex and crypto education and analysis. In today's edition, we're going to be looking at Advanced Technical Analysis, Candlesticks Part 1. The Japanese candlestick is the most widely used technical tool used by traders across the globe. Japanese candlesticks were invented in the early 15th century by the Japanese government of the time. They were used to record price movements on Japan's rich exchange. At this time, rice was not only the primary dietary staple, but it was also a unit of exchange. Candlesticks are used in trading in most of the asset classes, however, they are a particular favorite in the Forex community. In example A, we can see two candlesticks. They consist of 4 price inputs, open, low, high, and close, which are defined by a real body which displays the open and close, and a lower shadow and upper shadow which show the overall high and low of that particular time zone. The left-hand candlestick with the white body denotes an ascending candlestick. The candlestick has opened and at some point moved to the low. It has then moved higher, above the open value of the exchange rate, and thus creating this solid body. The candlestick then moves to the high before falling back to the close, and where it has left a shadow or wick on the top. The second candlestick is a descending one. It usually opens at the point where the previous candlestick closes. This time the real body is black. At some point the candlestick has moved higher before falling back below the opening value of the exchange rate, and thus now leaving a solid body, before eventually moving to the lower point and subsequently moving higher to the close, and thereby leaving a lower shadow or wick at the bottom. Candlesticks can be color-coded to suit, but this is the basic of candlestick trading. Traders look for patterns when studying technical analysis, and these offer short-term signals that identify relationships between supply and demand. They also help traders to identify areas of support and resistance, which are also called floors and ceilings, and these are areas where price action tend to find it difficult to break through. Example B shows two completely different candlesticks. Each of them provides a trader with information about activity within a particular time frame. The black candlestick on the left is a bullish candlestick, where the open and close are far away from each other and where the close is near the top of the overall movement during that time frame. This tells traders that this was a bullish move, where considerable amount of liquidity has pushed the exchange rate higher and that the subsequent move may well continue to the upside. The white candlestick on the right, however, shows a long shadow at the top and a long shadow at the bottom, with a small body and where the opening price is close to the closing price. This candlestick is known as a spinning top and tells traders that there is a lot of indecision during this time frame. Neither buyers or sellers were particularly in control during this time frame. Therefore, traders will be cautious because the candlestick also represents consolidation of price action and where no real trend has been defined. Generally speaking, in a bullish or upward trend, traders will see more black candles than white, and in a bearish downtrend, they would expect to see more white candles than black. In a consolidating or sideways moving trend, traders would expect to see an even amount of black and white candlesticks, which would be bouncing off areas of support and resistance. Example C shows a bearish trend, and with the last candlestick, which is known as a Takuri line setup and is very similar to the hammer, has pushed all the way down to a critical support area before buyers have come in and bought it all the way back to its closing level. Therefore, it has left a long shadow which is bigger than the body. Traders will see this as a potential trend reversal and take the necessary steps to close all or part of their bearish trend and wait to see what happens to the subsequent time frame. In example D, we have a bullish trend where the 3 ascending candlesticks are fairly large in size with relatively small shadows, followed by a candlestick with a long shadow either side of a small body and which is known as a spinning top. Although the closing price is above the opening and therefore an ascending candlestick, because the body is small, it tells traders that there is indecision at this point and therefore there could be a reversal in price action. The next candlestick is a bearish candlestick which confirms the previous upward trend could be over, and this is followed by a bearish engulfing candlestick which gets the name because it involves at least 2 candlesticks in an upward trend. The ABC positioning of the bullish candle, followed by a spinning top and then a bearish candle, is known as an evening star formation. If you enjoyed the video, please like and subscribe and comment down below if there's anything you'd like us to cover in future, or if you would like to discuss the topics we have covered. Have a great day.